If your business is making serious profit and you're still only using a solo 401k, there's a good chance you're overpaying taxes quietly every single year. Not because you're careless, but because the plan you're using was never designed for this income level. By the end, you'll understand how each option actually works for taxes, how large the savings gap can become in a typical high profit scenario, and which lane usually fits different types of business owners. This breakdown is designed for business owners who are generating solid profit, often in the low to mid six figures or higher, who are either owner only or have a small team where retirement plans are still mostly about the owner, and who are focused on legally reducing current taxes while building long-term retirement savings without needing to become a pension expert. Everything here is educational, not personal advice. The mechanics you are about to hear are simplified so you can understand the trade-offs and then take better questions to your tax and retirement professionals. Most owners start with a solo 401k because it is familiar, relatively simple, and their CPA or custodian can set it up quickly. The problem shows up later when profit climbs and the plan hits a ceiling. At that point, you are still paying a large tax bill while feeling like you are already doing the right thing with a 401k and wondering what else is even available. To make this concrete, imagine an owner with $400,000 in business profit, sitting in a high combined tax bracket once federal and state taxes are stacked, with no full-time employees beyond themselves or possibly a spouse. At this level, the difference between a solid, simple plan and a more aggressive structure can easily mean many tens of thousands of dollars in taxable income each year, going either to the IRS or into a retirement structure for your future. That difference is the gap we are highlighting, meaning how much room a solo 401k usually gives you versus what can open up when you add a cash balance plan on top. A solo 401k is the go-to retirement plan for owner-only businesses. It lets you wear two hats inside one plan, employee and employer. In plain language, that means as the employee, you can contribute a portion of your compensation up to a certain annual limit, often on a pre-tax basis. As the employer, your business can also contribute a percentage of profits up to another limit, subject to overall caps that apply each year. In a $400,000 profit example, a well-structured solo 401k can often let you put away a meaningful chunk of income in a tax-favored way by combining the employee and employer sides within the allowed limits. The result is straightforward. You get a sizable pre-tax contribution that reduces taxable income this year, along with tax deferral on growth inside the plan. The strengths are clear. Flexibility, because there is usually room to adjust contributions based on how the year is going. Simplicity, because administration and costs are generally lower compared to more complex plans. Familiarity, because many custodians support these plans and most CPAS understand the basics. But here is the key limitation. At higher profit levels, the solo 401k eventually hits a ceiling. Once the allowed contribution room is fully used, every additional dollar of profit above that ceiling is fully exposed to current tax rates. A cash balance plan is a different kind of retirement plan that often gets layered on top of an existing 401k. Technically, it is a type of defined benefit plan, but in practice, owners experience it as a way to move much larger amounts of profit into a tax-favored bucket when the numbers justify it. Conceptually, it works like this. The plan promises a defined benefit for you in the future. An actuary calculates how much needs to be contributed each year to fund that benefit. Those contributions, when structured correctly within the rules, are typically deductible to the business. For a high-income owner, especially someone in their 40s, 50s, or early 60s, this can create room for significantly higher annual contributions than a solo 401k alone could ever allow. The contribution range depends on age, income, and how aggressively the plan is designed within the permitted boundaries. In the same $400,000 profit scenario, a properly designed combination of a solo 401k plus a cash balance plan can often open up a much larger total contribution range than the solo 401k by itself. That means more profit shifted into a tax-deferred structure and a correspondingly larger reduction in current year taxable income. The trade-offs matter. Complexity increases because the plan requires actuarial calculations and ongoing administration. Commitment matters because contributions are generally expected to continue for multiple years rather than being treated as a one-time move. Costs are higher due to setup and annual maintenance compared to a solo 401k. So a cash balance plan is not simply a larger 401k. It is a structured tool built for the phase where income is high enough that the solo 401k alone no longer uses all the room the law allows to reduce taxable income. Let's stay with the same profile. An owner earning $400,000 in profit in a high tax bracket with no employees beyond possibly a spouse. With a solo 401k only, employee and employer contributions are combined within the annual limits, resulting in a strong but capped total contribution. That contribution directly reduces the portion of $400,000 that is taxed this year. Now compare that with a solo 401k plus a cash balance plan for a high-income owner whose plan design supports it. The solo 401k is still used, but on top of that, the cash balance plan allows a significantly higher additional contribution range, especially as age increases. The combined contributions reduce taxable income far more than the solo 401k alone. The key idea is not a precise dollar amount because that depends on age, plan design, and specific rules in the year the plan is established. The key idea is the gap. At certain profit and age levels, the difference between using only a solo 401k and using a solo 401k plus a cash balance plan can be substantial in terms of how much income is deferred and how much tax is legally avoided in the current year. You can think of this visually as two bars. The first bar represents the solo 401k contribution, which rises to a solid height and then stops. The second bar starts the same way, but the cash balance contribution stacks on top, creating a much taller total bar. That extra height represents income that could have been taxed this year, but is instead moved into a retirement structure under current rules when the design and the situation support it. A solo 401k often fits owners who are still in earlier or middle stages of growth, who have solid but not consistently high profit, who want meaningful tax savings while preserving flexibility if income fluctuates, and who prefer lower complexity and simpler administration. A cash balance add-on starts to make more sense for owners who have reached consistently high profit, where the solo 401k limits feel restrictive, who are in peak earning years and want to capture those years by moving more money into tax-favored structures, who are comfortable with multi-year commitments and additional professional support such as actuaries and third-party administrators, and who understand that higher contributions come with more structure and responsibility. There is also a timing dimension. Many owners simply outgrow their solo 401k. It works well when profit is lower, but once income and age align, the question shifts from whether it is a good plan to whether it is still the right primary strategy for the tax bill being faced today. So between a solo 401k and a cash balance plan, the real difference is not just complexity. The real difference is how much pre-tax room opens up at a given income level and how much structure an owner is willing to accept to capture that benefit. A solo 401k is a flexible workhorse that gives many owners exactly what they need in early and middle stages, and for some, it remains the right fit long term. A cash balance plan exists for a different phase, when profit and age make higher contributions both possible and attractive, and when operating inside a more formal, actuarially driven framework makes sense. The gap between these two setups can be significant in terms of current year tax savings, but that gap only matters if the numbers, the comfort with commitment, and the rules in a specific situation actually support using it. The safest next move is to treat this as a framework rather than a verdict, and to run actual numbers for profit, age, and goals with qualified professionals who can evaluate the full picture so that retirement design is built on real calculations rather than guesswork or one-size-fits-all shortcuts.